Hello and welcome to another episode of the ElysianNxt Podcast. I'm Nida, your host for today. I'm joined today by the CEO and founder of ElysianNxt, Chris Puype, and Jirachaya Kullertprasert, Senior Functional Consultant at ElysianNxt. Today, we will be discussing the very timely topic of the recent SVB crisis and its impacts on the financial markets.
Silicon Valley Bank is no more.
And in the last 24 hours, many founders, investors that I've talked to have been desperately trying to get their money out.
Our banking system is in a fundamentally different place than it was, a decade ago.
Many economists are now asking if the Fed will hit pause on further rate increases.
The question now, though, is whether the collapse of this tech-friendly regional bank is the start of something more serious, or just what happens when higher interest rates give companies less room for error.
Chris, a couple of weeks ago, you gave a lecture on the lesson learned from the great financial crisis. What is your opinion on this SVB crisis?
That's right, Nida. One of the reasons that I give this lecture on the great financial crisis is to put things in perspective, because I'm surrounded by a lot of young colleagues like the two of you. You might have vaguely heard about the subprime crisis. And one of the last slides in my presentation is, will a crisis happen again? And I respond to that question by quoting Michael Douglas from the movie Wall Street. So greed, by the lack of a better word, is good. Greed is right. Greed works. What I mean with that is that it's in human nature to strive for more money, more profit, an increase of the share price. In order to protect the financial system, you need to basically have proper controls in place, so the global regulations, but also to have a regulator in place which is empowered to make sure that the proper risk management tools within the banks are being used.
So if I can add to this, in case of the SVB, I think there were some basic rules of financial risk management that were not being respected. So the most obvious one was the interest rate risk in the banking book. Yeah.
Jai, can you elaborate more on this root cause of the interest rate risk?
Yep. So actually they invested billions of dollars of deposit into the long-term fixed rate investment, where the rates of those bonds were near 0%. So you can imagine that those massive amounts of mismatch on their balance sheet created a serious risks in a rising interest rate environment. So that result in a large unrealized losses to the bank. So that jeopardizing their capital. So when you think that Fed increases interest rates, so the value of those long-term bonds are dropping heavily. Yeah.
Let me try doing quick analysis with Elysian too. So going into the model. And under the interest rate shock for USD, as you can see, we have set the USD shock to 200 basis point shock up and down in parallel. And for the shock ramp, this is set to an increase in 20% shock for every couple of months until it reaches 100%. This can also be configurable. And with that setup, let's go to the deck and run the result in real time. So I'm gonna configure using that model that I had just set up and then do a calculation. So the calculation will show the result of what the EVE will be impacted by the setup that I had just said, that the interest rate will hike. Same case as what happened to the SVB. So with the result shown here, you can see that it is expected that the EVE will be decreasing by 26 million. This is what happens if the interest rate goes up. I can also do the contract analysis. For example, for this contract, you can see that it expects that the value of this contract will be decreased by 15% if the interest rates go up. So this is the impact that happened to the SVB bank when the interest rate had gone up. and their value gone down.
That doesn't seem rocket science to me.
It's not, it's a matter of managing your risk. So basically, SVB had an enormous unreached bet on interest rates staying low, and that bet went wrong. So with some quick analysis on remodeling and stress test analysis, they can see that their value will go down. So this leads to the question of why was this important risk type not managed by SVB?
Of course, I cannot talk on behalf of SVB themselves, but it's alarming that the best part of 2022, the bank went without the role of chief risk officer. So that says something about the risk culture of that bank. So just because Forbes rates them as one of the top banks in US, so it doesn't necessarily mean that it's well managed in risk perspective. Yeah. So sometimes being less hip is much safer for the bank. Yeah. So with the sales of the SVB sales for those government bonds to raise capital, so that's those losses were reviewed.
So what do you mean by reviewed?
So basically, if you would like to sell a bond in the market, which has the lower interest rate than the market rate, you will need to sell the bond below the face value in order to achieve the same yield as the market rate. So that's a loss.
Yeah, so maybe if I can add to that, so the nature of what happened to Silicon Valley Bank is completely different with the nature of the great financial crisis, because there we were talking about basically, the securitized, subprime mortgages, which were sold everywhere in the world, which caused toxic assets all over the world. And basically, the ratings that these securities had did not reflect the true risk nature of these subprime mortgages. So in the case of Silicon Valley Bank, I think we can, talk about a classic case of borrowing short, investing long, with a yield that goes from an average 1.5% to 4.5%, and that's what caused that loss basically.
So I also heard in the news about the run on the bank. Chris, in your course, you mentioned about the run in the bank of the case of North Rock in 2007.
Yeah, the run on the banks, it happened again. And basically, a run on a bank is something that no bank can survive, because it's a matter of time, maybe hours or days before, you have to shut the doors. When that loss was reported, the important loss that you earlier mentioned, there's also some twittering that was going on of some venture capitalists that were behind some of the depositors that caused the panic and the run for the deposits. So it's ultimately a nightmare for liquidity risk management. In Europe, virtually all the banks need to report on their liquidity risk by virtue of two ratios, the LCRs and NSFRs. LCRs is meaning the short-term 1 month horizon, so that as a bank do you have sufficient funds to cover all your outgoing money in a time frame of 1 month. And it's dramatic to see that like Silicon Valley Bank with an asset size of I think $212 billion did not have to report those ratios. If we compare between Europe and the US, so in the US you have 14 banks who have to report those ratios. In Europe, 2,200. So it says something about the difference in regulation between Europe and the US.
So are you saying that the regulation regimes in the US bank is too relaxed?
I think it's how the political system in the US operates and the influence that the banking lobby has over the Congress. There's a lot of lobbying going on to fly under the radar of regulation. So we can discuss that about the global risk initiatives like IFRS 9 and Basel 3.1. But the state like US is dragging their feet to follow those international guidelines. Yeah.
SVB was a specialized bank in a startup tech scene in California. Are you saying that did that focus make the crisis worse?
And that's a very good point. So actually there was a certain hidden concentration risks, as yet the deposits were spread over a lot of startup tech companies. So these companies were tied to a lot of venture capitalists. So it's venture capitalists that collapsed and instructed their founder to withdraw cash quickly. Yeah, so the irony of this matter is that the venture capitalists are financiers, and they should have known better the consequence to the panic, to the exit. So just to summarize this story, so the focus on the fintech startup company and the hidden concentration risks to the limited number of venture capitalists was indeed like a crucial factor to this entire crisis.
Mm-hmm.
Yeah.
The collapse of SVB was followed within days by the collapse of signature banks. Was this just a domino effect?
Well, there's some similarities between the Silicon Valley Bank and Signature Bank. I mean, Signature Bank was also specialized in some of the niche sectors. You know, historically it was a powerhouse in the US real estate market. It was also very focused on funding crypto firms. So I think the combination of that focus on crypto firms, plus the fact that they reported that large part of their deposits was not insured. I mean, there's a protection of $250,000 in the US for depositors. Mm-hmm. So meaning that if you have depositors more than $250,000, you're not protected. So the combination of those two, I think, caused this domino effect to happen. And it's just alarming to see, or shocking to see, how fast these dominoes are falling. I mean, I remember on the Thursday, you know, there was a press release from Signature Bank to calm down the markets, to say, you know, we're a solid bank, you know, very diversified, blah blah blah. But 3 days later, they had to, you know, they went belly up. And in that same week, it was not only Signature Bank, but it was also Silvergate Bank with a heavy focus on crypto financing that went bankrupt. So there had to be a strong signal to calm down the market because panic was spreading.
Yeah. So which was basically the announcement from Fed and the Federal Deposit Insurance Corporation, right? Mm-hmm. So the FDIC is responsible to issue a guarantee of all deposits. So normally there will be a cap at $250,000 for the insurance limit. Yeah, so this exception was granted on the ground of systematic risks. And the exception is normally granted only to the systematically important banks with assets over $250 billion. Yeah, so ironically, SVB got the better end of the stick. Mm-hmm. Yeah, so the first thing is like dodging the regulatory oversight, and second, I think it's got bailed
out, yeah.
Yeah, bailed out. Yes,
indeed.
correct.
So they benefited from both sides.
Yes, correct. So I think we should have like separate debate on moral hazard, but at this time I think, the strong intervention was needed to calm down the volatility in the market. Yeah,
indeed.
So was there a link with what happened to Credit Suisse?
Oh, in my personal opinion, there's no direct link between what happened to the US and the whole debacle and the forced marriage with Credit Suisse and UBS. But of course, when there's a crisis in the financial markets are global. And there was turbulence in the market. Credit Suisse had an awful reputation. They were in all the major scandals over the last couple of years. And then there was just for me, it was like wrong communication at the wrong time. At the announcement of Credit Suisse saying there's material errors in our financial statements. Then the next day, one of the major investors, the National Saudi Bank, said that we're not gonna, put more money into Credit Suisse for a variety of reasons. That can count as some kind of miscommunication. If one of your major investors said this is enough, then you're gonna go down.
So, is this crisis considered done and dusted?
I don't think we can say that now. I think it's a bit too early to shout the victory already. Yeah, I think there's a long history of many years that there was an excess of liquidity that the world has received because of the easy monetary policy. Because we kind of believe or kind of live in the world that, the money was for free. What's the reason for that? Because many countries were printing out the money like without any guarantee back, like in the past that we have a gold back, right? But now they were printing the money like just for free, and then so a lot of excess cash was invested in the treasury bond yielding the low interest rates. But nowadays, like the priority of the monetary policy has changed to the battle against the inflation. So that's resulting in the higher interest rates. So I think it's a food for thought that if the Fed and other central banks still trying to continue pushing the interest up any further.
There's indeed still a lot of turbulence in the markets. I mean, we've seen Deutsche Bank taking central stage, although that fundamentally I think it's a very solid bank. Also, a very negative side effect that you see in the US is that a lot of deposits are flowing from smaller regional banks to the big banks because of that too big to fail image. So nothing can go wrong with the big boys. And that's very unfortunate because these small regional banks do have a very solid purpose. I mean, they're funding the local economy. And often they fulfill a need and a niche that sometimes is not interesting enough for the bigger places to fulfill. So it's kind of what you try to avoid is that even the bigger banks are getting bigger, but this is unfortunately a bad side effect. So too early to tell.
So it could be that we will have a follow-up session next month if the crisis continues.
Well, I certainly hope not. I think fundamentally, I don't think this is going to be a GFC 2.0. But in case there's further evolution, then of course we're going to have a sequel. Nida, thank you very much for hosting this session. Jai, thank you for this lively discussion about the root cause of the Silicon Valley Bank crisis and the need for solid monitoring and stress testing on the various different risk types. So to the audience, thanks for watching. And if you want to find out more how we can bring you to the next level of risk management, please do click on www.ElysianNxt.com. Thank you.